All right, everybody. Welcome back to the Dips to Rips podcast with my co-host, the legendary Howard Greenberg. And today, guys, we have a guest. He's known as Creed. Now, Creed has interviewed us on money.net. He is one of the hosts and executives, part owner. I'm not sure, Creed. What do you do over there, man?
I'm just a good talking head overall. I'm education advisor when it comes to it. And basically what I do is for all of the independent traders and even the people wanting to get into the toots world there, I help them kind of get that groundwork together. Small background on me. Over a decade in the market now. And no, I did not go to Harvard. No, I did not go to any fancy stuff like that. And I have still not been on the floor, but I look forward to doing that. I actually got my start in the penny stocks world way back when, and I was a self-directed, self-taught, poor man, working class aspect, and finally learned by the school of hard knocks, and after about a year and a half went live, and after that got some good mentorship, and now I work with money.net to help educate people in the markets. I run a hedge fund, and other than that, I'm just one of those stories of, hey, had no idea what was going on, and did the DD and did my work in there to finally get to a point of now I'm on here talking with you guys. And, we've got so much wackiness in the market.
Yeah. You're definitely a bit of a chartist too, as well. You like your technicals. You shared one with me recently. It's good to hear because your background is similar to mine. I mean, to be quite honest, I never really stepped into a college. Trading was presented to me like it's a game, like a video game, quite honestly. And, from the start, it's never been a fundamentally driven reason for me to ever enter the market. It may be more now that I've gotten a little bit more well-versed, but, it just proves and shows that it really doesn't matter what your background is, that there is, a specific profile for you to have longevity in the markets. And that's what's really important. And, my colleague here is quite a smart man, well-educated, and him and I, in terms of background is somewhat different, but in terms of how we view opportunities is very similar. And this is kind of how this podcast had rolled up. It's, two different walks of life, from two totally different backgrounds, and we really kind of mash up like perfectly in that sense. And so it just tells you that the market has always traditionally been viewed in certain ways, but that's not really the case. Traders trade and traders look for opportunity. And what this is basically a self-created business for you to make your own wealth. And it's all in your hands. Howard.
Yeah, and I would add to that, and it shows amongst the three of us that it's also, you can trade. A trader's a trader, is whether it be cryptocurrencies, whether it be stocks, whether it be options, whether it be commodities. Each of us dabble in each of those different realms. And all of them still have this. I've known Creed for a few years. We've been helping out Steve from Money, Big Beat from money.net do his Slack channel, and I was running the crypto part of it for him, and Creed was coming on and really going over, like you said, a lot of the educational technical parts of it, especially like book maps. I remember you introduced me to that, Creed, and how to use heat maps and things like that I use every day, and how that all translates, though. You know what I mean? It's funny to see, that it was like when I first started to Prosper, it was funny to see the same thing. Like Charlie, you and I used a lot of the same philosophies, a lot of the same indicators. It was, but from totally different worlds of doing it. Mine was all based about Bitcoin, and yours was, and you started, I believe, on penny stocks also, right? It was sort of your foray, or was it always
my foray into trading actually was more institutional, meaning we were backed by institutions. So I actually didn't dabble into pennies until way after the fact.
Oh, okay.
But, it really played out the same. I used to call it keyboarding, right? And so when I first started, I never traded with the chart. I literally traded with the trading dome, which is the ladder you bid and ask, and I would hotkey in and out. And what we were lucky at the time in 2007, we were actually able to see floor traders enter their orders. Usually they centered around evens and 50s. always talk about, you'll see a lot of liquidity just because of the psychological aspect at evens and 50s. And that's really what we would try to do, is that we see big bids jump in. When we see that bid ask tighten up near that bid, we would just try to pile in and wipe out those asks. My trading size wasn't small. At the time, Apple's like anywhere from like 220 to 310. This is obviously pre-split. We'd be able to buy upwards of like, 2,000 shares. It obviously depends on how, long you've been at the firm. The longer you've been, the better success you have, more buying power per trade you would have. And we would just step in, and if we start getting squeezed down, we dip out on that big bid. That was our liquidity just to get the hell on out. And that's realistically all I was doing, was just going back and forth and just keyboarding, hotkeying in and out. It's a little bit more different now. There's a lot more nuance. There's a lot more information. There's a lot more data compilation. And so I'm utilizing a lot of different, viewpoints. And I've kind of figured out what's really worked for me, what's worked for my eyes, and when I found a lot of success in terms of translation and how I read that information, process it, and then take action on it. And Creed, I guess that's a good question to start with you, seeing that you're kind of the self-made trader. What kind of technicals are you utilizing right now? You don't have to give us your entire secret sauce, but maybe kind of a basis of like, a bare bones background on what you like to use and what time frame you like to trade within.
So that's kind of the aspect of it, is as I worked through my trading, and I had several mentors and I worked through different industries, etc., it came down to the aspect of, I actually don't trade charts. I don't trade Apple. I don't trade Amazon. I trade people is what I do. And when you're working there on the ladder, when you're looking through that DOM and you see, okay, we're coming up to 289 flat, and you start to notice, and I noticed I was one of the few people in the industry that would talk about it during that, was there's a buffer zone in there. And it's typically, so if we're at 280 flat, it's going to be 279.85 to 280.15. And for
I utilize this 10 cents above and below.
Yeah, that little buffer in there. And that was the thing, though, is that I started to notice on there that, yes, you can draw a trend line on here. You can use a Keltner channel, a Swami if you want to get really fancy with things. But yeah, for those that are aware, go Google that one. You're going to be on a rabbit hole. And I actually did. Before I found that, I actually traded with a Swami for a while, and a Euler setup as well. But long story short is, I started to realize that if I could remove the symbol from any chart, the number one thing that mattered was price action and the type of participants within it. My thing is, I've always said, I am not a presumption trader. I'm a confirmation trader overall. So let's take a standard bull flag setup. Get the move up, it pulls in, and we're about to get that second break of the flag right in there. A lot of people like to buy right within that, oh, it's about to break. Well, me, I got burned on that so much, looking through my reports, going through it. So I came to the point that I actually evolved into utilizing Heikin-Ashi candles when it came onto this. And Greg, why would you use Heikin-Ashi? Yeah, because it's an average of ideas. And unless you're running a lot of money through the market, your trade really doesn't matter. I'm sorry, I'm just gonna be, putting on a $10,000 or $15,000 trade. To some people, yes, it is a lot of buying power. I get that. But to the broader market, let's be quite frank, 10K is
more than you're in trading way too low of a liquidity item.
You're trading out. Yeah, you're trading blue from back in the day.
You're doing some D-Gen crypto, coin number 891 on the CoinGecko list.
And that's the thing that I realize, though, is throughout the markets, it doesn't matter if I'm in gold and oil and beans, if I'm in the currencies and penny stocks, high equities, it could be anything from Boeing to, Herbalife, whatever. The type of people within that market, we're all trained to think and look at in a certain way. And This is something that gets me on a pet peeve, is VWAP or VWAP, for those that like to say that one. It was never designed as a trading metric. It was never designed for that. It was meant for when managers got in and went, okay, well, I want you to deploy $500,000 in Apple over a 10-day period. And we're going to say your volume weighted on an average price, I will give you 5 or 10% more. It was a metric used to whether or not people were going to get a bonus on how they were doing. But so many people started using VWAP as an actual tool of, oh my God, when price action gets above, or how many times have you both heard when the 9 EMA gets above VWAP, or, et cetera?
Oh yeah, man, because I preach this stuff.
And that's the thing.
Well, it's what I call it is it's a self-fulfilling prophecy. Exactly. A lot of MAs are self-fulfilling prophecies.
Of course they are.
So many traders use that 50 MA that it is a psychological, like you said. So, so it's kind of funny because I would say the VWAP, and I know both Charlie and Mike in our company use it a lot, and I'm starting to with our perps trading that I'm doing, because it is a self-fulfilling prophecy. If that's the psychological barrier for people, that they're not buying above that, then that's the psychological barrier.
Well, if you think about it like this, guys, if we're looking at an indicator that very few participants, let alone the big money, actually utilize or references versus where the general broad market is utilizing and, taking advantage of, it makes a difference because that's now trying to outsmart the market as opposed to trade with the market. Absolutely. And the VWAP in relation is, in my opinion, create the most popular day trading indicator out there. Now, what you just told me, I never knew. I've only known this as a reference, like the POC on a volume profile, which is highest traded volume price, right? Distribution above, bullish. That's really good. There's high level demand. Demand is coming in higher than previous, and it's keeping up price points. A major law of attraction right now for futures and futures contracts is utilizing these volume profile references. But if you actually think about these volume profiles, a lot of these just tie in with major swing lows where the market had pivoted. And usually when there's a pivot, especially in something as liquid as, like, say, the ES, right, the S&P 100 futures, it's usually because there's a large, heavy bid plus rip-roaring, offers coming in at market, or orders coming in at market to lift those orders, and that's how those sharp reversals come into play. It could be iceberg orders on that bid that's just auto-refreshing, and the market recognizes it, and all of a sudden there's that short covering pop. So I am with you in respect to not only technicals, but the psychological events. Psychological events happen every day in every single stock. And generally speaking, whether it's bullish or bearish, most of these take places at, pretty consistent levels, either the highs or lows, right? Lows, new lows, breakdown of lows. Why do we see sharper spikes down when we're making new lows? Stops are getting hit. People are panic selling out of their trade because they're trying to buy in at value. Why do we see spike pops at highs, especially after we see double tops? Well, we know that short sellers made their presence felt. Their stops are getting hit. When they need to exit, they're buying market. When, obviously when stocks go up, people are FOMOing out, they're buying market, and then we see that fast driven move. So, one of the things I always try to incorporate that, and it's funny that this is where engineers that try to become day traders struggle the most, because they anticipate that 1 + 1 = 2, which is, in their world, the only way that they could operate. But that's not how it is with the markets. 1 + 1 may equal 5. Truth be told, it all depends on what's happening in that moment at that price level of reference. All I can do as an educator, as a coach, is kind of talk about my experience and let them know what to look for, what nuances, what likelihoods, and what possible outcomes are. And, again, no knock on the engineers that are listening, but if you're an engineer and you struggle with day trading, it's because you're looking for definity. And again, we traders work on probabilities. There's a big difference, and probabilities have multitudes of outcomes, where definity is 1 + 1 = 2. And so this is where I try to get them to understand that this is where the feel and artistry gets involved. And, what we're trying to teach is, for me, my experience drawing all the way back to 2007, trying to teach everything that I know since then, through the trials and tribulations, to get someone that's just started to trade, to expect them to be able to experience all that in a very short period of time and then find sustained success. It's forever a learning game. And part of that is because it's always a different psychological sentiment and aspect to the markets, year in, year out. And now, especially nowadays, it's almost on a daily basis where everything is so dependent on news, being news driven. So how do you feel about that, Craig? How do you feel that this market environment, if you remember, right after COVID, all we did was just slowly melt up for $2 a day in the SPY. And now we're dealing with herky-jerky markets. How are you navigating through all of this?
So this comes down to something I said a very long time ago that someone said to me about a different business on this. And I felt like an idiot that I didn't realize it sooner. Was the market is nothing more than how we choose to receive, perceive, and then act upon the information being given to us. And with this particular market, we've shifted in that the way we choose to receive information, well, that could be through so many different things. It could be through data from money.net, a tweet deck, or it could be from Uncle Bill down the street. It's one of those things. Now, how you perceive that information is where a lot of people mess up overall, is because they start to go, oh, well, I saw this politician said this on this industry, and because of my beliefs and ideas, I'm going to let that affect my trading. Well, I can't do that. Overall, as a trader, you have to remain unbiased to what's coming through. And sadly, that's what we're seeing a lot of right now, is that there is so much commentary on that with that unbiasedness, and then act upon your definitive that you said earlier. The only definitives in the market should be one of two things, in my opinion. One, your risk management. Two, your thesis overall. That's why when I'm working with new traders, I tell them, if and only if this occurs, I will do this, that, or the other. Not I should, I'll think about it, or any of that.
Confirmation based, like you said.
I will.
Absolutely. Yeah. So with that being said, Creed, so what are you looking for tomorrow morning with CPI? And what are you going to do? What are you thinking about setting up before it? And, or with you being a confirmation trader, you're going to wait till the actual print, hits, and then how will you react to that?
So where I'm going to be working with the CPI data tomorrow is I'll be definitely on the ES and NQ, but I am going to scrub my size a little bit. Typically on ES and NQ, I'm running between 200 contracts, something like that on it. But with tomorrow's data and the way things are coming through, I've been running a lot of 50 lots lately, and I'm just going to really work with that aspect of, okay, what's the first 5 minutes that we're working through here? The data hits, and I have an idea that the data is going to send us up. I got a pretty good feeling about that, but that's a feeling. That's not a, this is the number. And we've seen this before, though, that data just gives us a right then, right there. The people putting money into the market are not putting money into the market for right then, right there. They're putting money into the market on those 2-week, 4-week, 8-week decisions for later on. So when that number pops out, they go, okay, based on this number, I suspect we will do this or that for the next 2, 4, 6 weeks. So I personally like to wait about 30 seconds to a minute after the number and let it swallow. I was trading gold the other week, and we had a report came out, and we had an $8 move in gold both ways in the course of like 30 seconds. And I went, that was cute, because I had a limit order in the market. By the time my order, thank God I was on the right side of it. By the time my order hit the exchange, it was well beyond where my stop was. So that's the thing. And that's something for the traders as well, as just because you put a limit order in there does not mean you're going to get filled. at that number. I just want you to keep that in mind. But that's how I'm looking at it.
That's a great point.
Push us up.
Now, Creed, do you guys ever play any kind of straddles going into a CPI where you're just expecting volatility? Or is that really not really within the structure of how you guys trade over there?
So for some people, yes. I'm more of a verticals guy instead of running straddles on there, because call me a scaredy cat, call me this, that, or the other, but I like having a little bit of insurance on the other side of things.
Sure.
And that's how I run a lot of that. And I would, especially in this market, because like we said, during COVID, we're $2 up, $2 down. Now we've been kind of stagnant for a bit, and the market's coiled. I don't care if you use advanced decline. I don't care if you use TTM like I do, trade the markets, the squeeze on there, or whatever, Keltner channels, Bollinger's. Even Bollinger said himself on there, look, the markets are tight overall. And what I think is very important for people to go back and look is when Russia announced that quick 2-day ceasefire, but what was it, like 5 days ago or something like that? What happened on that? That one little announcement, we were in a perpetual downtrend the whole day. That one announcement jumped the ES, I think it was like 3 points or 4 points, just off of a ceasefire because of a holiday. That is a algo reading the markets coming through, and short-term money being placed on headline news.
Yeah,
I don't want to be in front of that steamroller.
By the way,
I mean, and crypto, to be honest with you, works pretty well because of the way you can play the perp market against it. The sort of gray area of crypto works well with a straddle tomorrow. Put a short, stop loss both ways and follow the winner there. But we've also seen, another thing I've noticed within crypto, are you seeing more of it in the commodities that trade 24/7? I'm still seeing all of a sudden liquidity sweeps at 9:30 every morning on crypto.
Yes.
Which we did not really see in the past. So now I'm seeing that same little thing. You see that 15, 20 minutes. I stopped trading. Like you said, I'm looking for confirmation in the morning now, really not entering trades till after 10 o'clock, because we're just seeing this unpredictable chop of up and down where you could get hit on a fairly tight stop loss pretty quickly on a right call. So it's, so that's what I've noticed too. I was wondering if that's hitting the commodities and currencies.
Well, it is overall. And Howard, I got to lean on you with this one as well, but because when I'm trading my crypto, BTC, ETH, I trade the major things. And I got a few little side things over here that I work with, but they're not the things that I trade every day on there. And I've started to notice that the ATRs, the average true ranges, are severely tightening up overall across currencies, crypto, commodities, equities, all of that. And I've been an ATR guy for a long time, but I'm not a standard ATR guy. I'm not a 1.5 on the risk. I always do a 1.3 on mine, because for those unaware that are listening in, ATR is your average true range. It's the average movement that something has made over typically the last 14 periods. And it's a metric used both on independent and institutional side of things, but more so for algorithms as well. In the crypto market, we know for a fact there are an umpteen amount of algorithms in here. And as we're seeing that movement at 9:30, that lets me know something. There is a new type of participant within the market that is correlating their day off of what? The U.S. Open
equity
overall. Open. So that lets me know that, okay, we do not necessarily have as many global participants. So we all remember when BlackRock bought into, what was it, like 8% of Coinbase or something like that, et cetera. Goldman has a desk. Well, we start putting 2 and 3 and 4 together, and we start to realize that, okay, if a major portion of the crypto world is now being utilized by what? US-based companies, those whale wallets, those whale traders are going to trade on those people's time frame. When crypto first came out, what type of time frame was it typically utilized with?
Asian hours.
Asian sector. Exactly.
Yeah, and the other part that would go exactly with what you're saying is the Asian market makers were hurt more by FTX's collapse than the U.S.
They're
based
white.
ones too.
They're
So
white.
Taiwan especially had a lot of their institutional money was based in FTX. So that's also changed that. So that's something I've definitely noticed has definitely changed my trading style. Charlie, how about you? Are you seeing, with the way that, to me, it seems like retail is looking at anything even remotely optimistic in their buying? Are you changing how you're looking at some of your indicators and your buying patterns, and trade patterns right now?
Sorry, I'm actually coaching people through the chat in my room. Breaking news: BBBY is pumping. So I got people in right now. I think that it's actually going to try and moon out. This is something to watch over the next few days. They're definitely trying to short squeeze. I also want to say, before I answer Howard's question, guys, let's not try and short a stock that's under $10. It doesn't make sense. It sets you up for margin calls. Mike had that comment the other day in our coaches chat that someone wanted to load up on puts at that $180 price range. I'm like, why would we want to do that? And here they are with absolutely no shot as BBBY is trying to squeeze up. Now, in terms of tomorrow's CPI, JP Morgan came out with a note and they're quite bullish. Goldman Sachs actually came out and said they're quite bullish. And this is leading back to the last CPI. They both came out and said the same thing as well, that this report should actually be a bullish thesis for the near-term traders, which could lead to a short squeeze pop. So last time the CPI jumped around 2.25% in pre-market trading on the CPI data and then continued to melt. It melted down that it finished down over 1%, maybe even perhaps down 2%, just an absolute insane reversal. And that leads to what tomorrow can bring. The way that we closed today, I mean, we're up 1.76% in the NASDAQ. It was a big risk on event. VIX finished up for the day up 2.5%. And it seems like there was a lot of protection being bought. VIX obviously being bought up, so VIX calls and SPY call put activity. I mean, there was a ton of put buyers. I think it was like 3.3 million calls, 5.2 million puts, and 71% of those puts being bought were at a delta 40 or less. 44% of the total volume was at a delta of 20 or less. So they're way out of the money in those. Just in case it was dynamic, it was a bit of a hedge. It makes a lot of sense. Where can we follow through? I don't know. I mean, this market looks freaking good right now. I still have a lot of bearish trend indicators right now. My ATR trailing stop is flipped and on the sell side overall. But I mean, SPY powered through some key levels. We're approaching the 200-day moving average in the SPY. NASDAQ, which has been a laggard, is really starting to come up. It really does look like the market has finally balanced out and found a bottom. Now, what could lead us lower? I mean, if inflation data comes up, it's pretty simple. If we see an uptick in inflation, this market's going to keep going. They know that's not done yet. We'll make new 52-week lows. But we've been on this really nice trajectory in terms of stronger economic data, weaker inflationary data. And I mean, quite honestly, this is largely attributed to the fact that, crude hasn't sniffed 100 in quite some time. And since that spike high in November on the OPEC plus news and leading to that OPEC plus 2 million barrel per day cut, all we've done is glide down. We tested $70 where, the United States was supposed to replenish their supply, but we're just barely hovering above this level. We're not extending beyond. We're rejecting at technicals like there isn't war going on anymore. It's pretty confounding. Maybe it's because of the warmer weather that's hit Europe. So nat gas has been a little weak on that news as well. Nat gas, UNG made new 52-week lows. But I don't know. There's a lot of signs that this is starting to say that it's more than just a bear market rally, that we may actually start positioning ourselves to at least withstand the downside, balance out, and then work our way towards the end of the year, which everybody's anticipating a rally. So I guess that's what it is right now. Just don't let it be any worse. we'll hold on, and then we'll just bide our time, and then we'll eventually go up. I expect a lot of volatility. You know, how the market comes from Q1 earnings is going to be super important. We start earnings this Friday here. Yeah, I don't know how the banks are going to report. You know, that's usually a good indication, but you know, it's always the second week when Tesla and Netflix reports. They're the first two out of the major big tech names. And you know, if we just start seeing these companies rolling over crazy, it's not going to be good in Q2 up to Q3. But if we're able to withstand the storm, and again, corporate numbers aren't as bad as people may expect, I mean, we may catch the Bears really off guard here going forward. I'm not trying to pull on a bullish thesis, but you know, I don't think we're going to finish the year down, and if we are, it's not going to be more than 1 or 2%. So long answer short, looks like the technicals are starting to turn a bit.
And that's the thing, I've got to agree with you. But the question comes to ponder, during all of this movement down, people really didn't care about the earnings number. They cared about the forward guidance. I always like to analogize on this one that we've got snacks now, but is there a restaurant 2 hours down the road? I'm curious if that's still going to be the case in the Q1 through here. Is, do people really care that much on, oh, they beat by 5 cents or they were down by 2 cents? And the more so going to be on the idea of, okay, well, we get it. Everything's been bad for what, the last 3 earnings periods. How are you guys changing this? Because we've seen a shift in management, and what I've been calling the substitute CEOs are starting to step down, and we're starting to see founders come back.
Yeah.
I believe that from these announcements that we're going to see, companies have to start to actually innovate and not go the way of Apple. I mean, Apple had an announcement today. Oh, we're going to put a touch screen on the Mac. Last time I checked, the Microsoft Notebook had that in 2014. Like, welcome to the 21st century here. So it makes
I thought Apple already tried that with like the volume gauge and stuff, and like people hated it. So the next generation they took it off.
The Magic Bar stuff, and now
I don't know.
Actual. Well, that's the thing. Apple's not doing anything overall. Did you see their last thing? It was basically buy our watch so we know you have a heart murmur or you're going to die. That was basically.
And we could find you in the middle of the desert.
Go look it up. That's how it was. I was so grateful though. Tim Cook didn't come out looking like a ninja. Anytime he comes out in all black, he looks like a ninja to me. But that's the thing overall is I want to know these legacy companies, because what's Kodak going to do? What's IBM going to do? What's this, that, and the other going to do to innovate for metaverse? What are they going to do to innovate for what we're coming through? Because something that sadly is not making headlines right now, and I talked about it on the morning show on money.net there, was the fact that on the West Coast right now, we have one of the biggest storms that they've had in over a decade coming through. For those unaware, the West Coast of America is what's known as hard pack. They can't absorb water. What does that mean? Massive flooding. So I'm actually looking at relief plays. I'm looking at Caterpillar, Generac, etc. Because don't get me wrong, Oregon and stuff like that, yeah, okay, they'll be all right. But last time I checked, San Francisco is not ready for a Cat 4, a Cat 5 hurricane. They're going to be really flooded. And this makes us wonder what is going to be the play. I was talking with Don Dawson. He's a very long-term commodities trader earlier today. And I asked him, do you think it's going to be a wet year? And the guy couldn't get yes out of his mouth quick enough. So with everything we've got going on for the grains, for the industry, for the logistics, it's not looking great, but it's not looking horrible as well. I think we're actually going to have a slightly bullish overall year, but we're going to have kind of a negative Q1, Q2, because people are starting to change that sentiment. I mean, it was what, short everything or buy SARK last year. And right now we're pretty much dancing between that 380, 390 on the SPY, but the market's so coiled up. If that storm hits hard enough and we get those reports, they don't even have to be valid. But if we get the headlines of California's underwater, Arizona's underwater, where do you think that's going to send the market? You sure as hell ain't going to send it up. You know, that's something to keep in mind.
I mean, Well, that gets me to my question for you, Creed. I know that you are a chicken owner there. Speaking of catastrophes that are hitting the market, so to speak, is I happen to get some data from Cisco, U.S. Foods, some of the food guys today, and they were talking about the avian flu and issues in egg prices that have skyrocketed. What are you seeing there yourself?
Well, it's a hard-boiled situation that I think is going to fuck over a lot of people.
Oh, that's
So,
it. We just
there
got
we go.
canceled.
There we go. On my resume, it says dad joke.
Excellent fun.
I love it. I love it.
Now, on a serious note, it is an issue, and eggs themselves are they're like an eraser on a pencil overall. It's such an easily overlooked thing, but everything from protein powders, baby formulas, other brands out there, a symbol people can look at is FAT, Fat Brands overall, that deals with the restaurant industry. Look, the IHOPs, the Waffle Houses, even your Applebee's and your nicer restaurants like your Ralph Steakhouse, your Marshall, etc., all of that, they're going to have issues, and they're going to do one of two things. They're either going to have to cut revenue, which is going to hurt the stock, or they're going to charge more. But we just saw the report come out today on savings there. People have less than 2% in savings overall. Right. The statistic came out that most people would have to sell something to go and cover a $500 unexpected bill. So if your Applebee's meal went from $28 to $40, your average mom and pop is not going to go there overall. Right. They're just not. Right. So I'm long eggs in the idea, but I think it's going to hurt in Q2, Q3 if it can't get under control. And for those unaware, I have a background in ag. One of my degrees was from Abraham Baldwin on there in diversified agriculture. So I've dealt with this a time or two.
So my man knows what he's talking about.
Well, I presume to know what I'm talking about overall. I've always said that I'm only the half sharpest knife in the drawer. But the idea behind it is the efficiency of those chickens, because they're bred to a certain lifespan. Yeah. And they're bred to a certain capacity overall. But with this avian flu, we're not meeting capacity, and you can't speed up how fast that chicken starts laying eggs.
Absolutely. So even that's what it is. The supply chain is not, you can't. And the fact
that you got a lull. You still got a 2 to 3 month lull.
Yeah. And they were warning that this is, now going to be a repetitive problem because they can't seem to, get rid of it like they did back in 2007 was the last time that we had seen avian flu in the U.S. at a big level. That this is going to be reinfections and stuff. So just something interesting. I knew that you had that background. Thought I'd throw in there the question about the eggs. See what you thought there.
This is Charlie, the first time you made history. First time we've ever talked about chickens on this podcast.
Absolutely, man. We cover it all. Dips to rips, baby. You got to know it all. Got to know it all.
Creed, don't want to take too much of your time. So if the listeners want to find you, how could they find you, my man?
All righty. So the easiest way to get a hold of Creed, money.net, obviously hop in there and you're able to get a hold of me. But I'm pretty active on the social medias. You can go to, I think it's at Creedmoor_MNET. You'll see me on there. There's a photo of me standing on a cliffside. You'll be able to see me, and you'll see I post every day on there. And you can find me LinkedIn, same places, but easiest places, Twitter, Creedmoor_MNet, and then the money.net pit, and then right here on Dips with Rips. And
that's what's up, man.
That's the best way to get a hold of me.
We'll make sure to put your socials down in the description below. So as we wrap this up, Howard, any last parting words, brother?
No, I'm with you. I do think that we have upside potential here. I think people want to be optimistic on crypto. I will say we still have some macro overhang that you guys don't in equities, which is Sam Bankman-Fried, and DCG is still under pressure. They did try to settle with a couple of their creditors, The two largest creditors both have fought back and said, you've got plenty of money, Barry Silbert, give it to us. We're not happy with 70 cents on the dollar. So that does put some headwinds in for crypto, but I am bullish going into tomorrow with you. I will be looking for reversals, though, like you said, Creed, also. I do think that we pump for a while. I don't think it lasts necessarily for days, but let's take advantage of it while we can. Make sure you set some good trailing stops in your trades tomorrow. It's going to be a little bit of volatility. You know what's going to happen is everyone's ready for volatility. It was a couple of reports ago, remember? We were all set and it did nothing. It was a big dud. Like nothing moved. I think Bitcoin moved like a half a point. I sneeze and Bitcoin moves a half a point. And it was like, well, what just happened? We all sat here all day excited. I opened my room an hour early on these days because I get so excited about it. And it was a nothing. So let's hope tomorrow that we get a little fireworks and then in the right direction.
Yeah, guys. So again, if you like what you heard on this podcast, do us a favor, like, comment, subscribe, click on those notifications, drop that comment and let us know what you want to hear up next. Don't forget to hit up our man Creed. Just want to say thank you for your time, gentlemen. Everybody, peace and love. See you next time.
Thank you so much, guys. Thanks, Creed.
This has been Dips to Rips with Howard Greenberg and Charlie Moon, brought to you by Prosper Trading Academy. Visit us at prospertrading.com to find out more. This podcast should not be considered professional, financial, and/or investment advice. By accessing this podcast, you acknowledge that Prosper Trading Academy LLC, PTA, makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information and opinions presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. PTA does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. The third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of the PTA. PTA assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials of the third-party sites referenced in this podcast, or the compliance with applicable laws of such materials and/or links referenced herein. Moreover, PTA makes no warranty that this podcast or server that it makes it available is free of viruses, worms, or other elements of codes that manifest contaminating or destructive properties. PTA expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast.